How you doing, Alexander and Richard? Laura, how are you? How's everyone doing?
Morning, Dale.
Top of the morning, Ryan.
Top of the morning, sir.
Isn't that what they say? Hi. How are you guys?
Well, good, mate.
It's not that early. It's only 5 a.m. You know. Anyway, so yeah, I get to hear an owl in the morning. I'm having an identity crisis because he keeps saying who, and I go, it's Dale. It's Dale. He keeps going who. Dale who, he said today. Anyway, so here we are, after the slaughter in the S&Ps and, risk off. One thing I did notice, even though I don't think it's bottomed anymore, maybe it has, was how Euro held up during risk off. I wanted to ask you, Ryan, because you called the last low in Aussie. I'm kind of waiting for this. We did clean out all the stops yesterday under this double bottom. You believed this double bottom and capitalized on it. You doing anything here yet to recommit, or are you going to wait?
Well, I'm still holding my longs, but as I said last week, I've been very cautious about them. I very nearly folded them yesterday just because I was like, no, it's gone, it's done.
Yeah.
But I want to see if that was a bit of a flash. I've got my stops in at 68.80.
Okay.
It means I'll give back a bit of what I made cutting on the way up to 75s. But
yeah,
trading. But I'm going to see if I could. Sometimes I just need to put in the red line. If it goes under there, I'm done. Otherwise, I'm see if I can stretch it out to see what CPI does.
Did you trade around it on this rally and take pieces off? Or
yeah, my average was around 72.30 odd or something. So when it got up to the 75s, I started taking some off.
Yeah.
But I'm going to give some back, but I'm not.
I forget how patient you could be when I think you're one of the only guys I know that held a currency position for over a year. So you did that in yen, and I want to get to KMan here. Yields seem to have peaked. I know I'm the boy who cried wolf. I've thought so a few times, but I know tomorrow's a big number, but this action and we had pretty glaring divergence here at the highs and sitting on a 9-day here going into was it CPI tomorrow, guys?
Mm-hmm.
Yeah. So, I think that the market's going to, I think they'll fix it so that it'll be 1/10 under expectations and the market will fly and yields will come off. And maybe even if it's not and it tries to rally, it's going to have a hard time making a new high. It won't confirm. So I don't know about you guys, but it looks like it's possible that we're setting up a reversal week in 10 years.
I was looking at that. You have the 3% mark, but then this morning I was looking. Is it a F.A.C.E? Somewhere around the 280 for the last leg higher, or 280 or 285. And we have a plethora of Fed speakers on as well, and some of them seem to hint at somewhere around 2.5% being the neutral or target-ish, and then see if they need to go over it or not. So if it's 2.5, then if you look at the shorter term yields, like the 2 years is still around 260. I think there's perhaps another 10 BPs to come off, which could translate in the tens to come back to have a look at that 285, 280 zone. And I think as long as we hold that, there's not too much of a change. Of course, you have your as you were saying, your divergence. We could have seen the top. I think the big one will be 3.4%. If that flies through, then I don't know what's going to happen to the Dixie and the dollar, but it's not going to be pretty for a couple of currencies, I reckon. But for now, in my opinion, we could stall around here or even get those further 10 BPs loss which could in turn then translate in a slightly lower dollar, which might save the S&P until QT kicks in. So we are in an interesting zone, or coming up to at least.
It's kind of a, the market's in the position that a lot of things you feel too late to do, and to take the other side, you feel too early to do.
Yeah.
So you're, most of your energy is going into being able to sit, which for me it takes energy to not do anything, to control yourself, right?
Perhaps for the medium term, the best position is doing a notice reading. It's like sitting on the dock of the bay.
Okay,
And
yeah.
Wait for it to develop.
Yeah. Okay. Yeah. And we'll see what I think tomorrow will be a big day.
Tomorrow will be tomorrow is going to be a biggie. Although if we get similar kind of inflation numbers,
the market can't wait to say peak inflation, and all it'll take is like 1/10 less, and they'll proclaim it.
Yeah, probably.
So that's what I think. So we're getting bounces in metals too. They seem like, sympathy bounces. I mean, the silver still looks bad. What's interesting about silver is that a lot of the shares, aren't just taking out these lows. For example, here's a couple of the juniors just to show you the different picture. Here's it's a pretty popular one right here. This is First Majestic, and this is more of a junior Endeavor. I like this one.
So you think it's a stock dragging down the metals?
I think that they didn't have that great of a rally, the silver stocks anyway, but the gold stocks did. There's a big difference. I mean, we're making new lows in silver shares, and I think we're just getting a correction in the gold shares. So
I think stocks are taking everything with them, right? Everything.
Yeah. But there's
low rates are.
I think we still can't forget the difference in how gold and silver are influenced. Silver is much more of an industrial metal than gold is still has more speculation and inflation, I think, in it than silver in the end. When the economies will reopen, I think silver is going to be a screaming buy if prices keep certain levels.
Well, I asked Julian Brigden about it last Monday when he was on at MI2, I believe it is. I think he's a secret agent besides an advisor. So isn't that the name of your secret agents in the UK? MI something?
MI6, MI5.
Oh, okay.
5 and 6. He's still waiting for a promotion.
Yeah, he's still in grammar school. He's at 2. So he was saying, I asked him about silver, and he showed a chart that showed when silver was bottoming, it was exactly at $1 high. And when silver topped, it was exactly at $1 low. So we still haven't seen the dollar top yet, right? I mean, maybe we're getting closer. But that was an interesting chart. It was on the button that the silver is more influenced by the dollar than gold. Well, gold went up when the dollar was still rallying, right? Before this recent sell-off. So I think we have to wait for a turn in the dollar to get bullish silver, and probably wait for this to peak out too.
It's all about the levels, isn't it?
Yeah.
We've had some big moves, and you always get a pause. We saw it in dollar yen when it ran up first to 129s. We had a pause for a week or so, 2 weeks. Then we had the next one up to 131. Now we've got a double top up there and a pause. So I was saying this morning, you can't think that market's always going to go one way all the time. Everything pauses, and then from that point you just see what levels develop, and you take it from there, and then you look to trade the breaks or the pullbacks.
Maybe we have to take out the seventh, the low in 2017. What is that? 103.40.
Yeah,
So, go to 102 and change.
Yeah, but look how solid that 105 level's being without giving it the kiss of death.
That's a monthly. So yeah, we have inside weeks. I think I talked about this last week. That now we might have a double. I doubt we'll stay within. See, this was within the previous week's range, and so far this is within the previous 2 weeks range. You get a couple candles like that, and then get something like down and then above these highs, or up and then beneath the lows. Usually you could get some type of engulfing candle after a couple of neutral ones, or sometimes just one. But it's holding. You're right. It's held this level for 3 weeks. Yeah.
It just shows why we look at these levels. I've been looking at that level for months. Sometimes they hold, sometimes they don't. But when you get a level like that, you've got to pay attention to them and see what the price action does around it. But conversely, it's not breaking higher, so that's the fear.
Yeah, and there's look at what stopped Canada yesterday.
Yeah, 38.2 fib there as well from the big fall.
Yeah, some real. Hey, good morning, guys. Some really big levels in the dollar CAD.
Yeah,
so, yeah.
I see your dotted lines there, buddy.
Well, hey, let's good morning, everybody. I hope everybody's doing well. I wanted to say that regarding the dollar CAD, we've been talking about this one for a while, and I'm fearful that what I've talked about over the course of the last several weeks is transpiring, and I'll go to it just really quick because the reason why I want to point this out is because I think this is a big deal when you're talking about risk appetite, risk aversion, and I hope I'm wrong here, but we originally saw this chart as a wedge. You can see it drawn out in blue. It's like consistent highs at 129.50. The rising lows, that was the wedge. Then we broke down, and we had this false breakdown right here. When I've said it for weeks now, false breakdown usually leads to a I meant to pull that over. Usually means a breakout to the upside. Well, that's happened. I mean, we're seeing it now. The question is, will it continue? And I mean, when you look at the dollar Canadian breaking higher, that tends to be a risk off type of sign. I don't want to get too in the weeds with this, but I know that the dollar Canadian and like volatility has a very tight correlation, and it has for years. And you can see it during periods of risk, when we have extreme risk off. I mean, you'll see the dollar Canadian tends to act, better during those periods. This is, COVID lockdown. But I don't know. Do you guys think that? I guess it really comes back down to what's happening tomorrow. How do you guys feel about the inflation data? Do you guys have a feeling on what you think is going to happen? Do you think inflation has peaked? Do you think we've I'm talking near term. Let's talk over the next quarter, not like peaking over the next 10 years. Let's talk over the next quarter. Do you think that we have reached peak inflation, peak hawkishness from FOMC members? What do you guys think?
We've definitely, I think, reached peak hawkishness. I mean, Powell came out and knocked off 75 pip hikes. Bostic did the same yesterday. The air's come out of the really hawkish expectations now, which is part of the reason why yields have dropped. The dollar yen's dropped back, and we're not really going much lower in a lot of dollar pairs. But yeah, as far as inflation goes, has it peaked? Well, the numbers will tell us. But do I expect it to keep rocketing up at the rate it was? No, I expect it to start moderating. But there's still a lot of lag to come in. The inflation data is lagging. So even though
that's important. I was going to say that's important to point out. I mean, so because you just said that, and we can continue your conversation. I'm sorry, your comments, but I want to ask this: if you think that inflation has peaked out, even if we have hot data tomorrow, so let's say that let's just say then the data comes in line. Do you sell dollars into that strength? Because then, if you're right. Any dollar move at this point should probably be faded, right? I mean, I'm trying to put two and two together, and I'm asking your opinion here. Possibly.
Depends how much the dollar value. I mean, if inflation comes at or above estimations, and we see a move in dollar yen up towards that 131 highs, then I'll be thinking there's your level to lean on. Lean on that double top if we get up there.
Yeah.
If we get up there and we can't break it, well, there you go. There's your trade. Simple as.
Yeah. Okay. All right. Well, that makes sense. KMan, did you have any opinion? And Stelios, I know you do. So I'm saving for you for last.
Ryan brought its charts to the football games he went to.
Drinking warm beer and reading charts. Nothing else I'd want to do over a weekend. Drinking warm beer and watching and looking at charts. Okay. So anyway, KMan, go ahead.
No, I really think if it comes out as expected, not a lot will change. They are on, the Fed is on a 50 BP per meeting hike for now. It's not going to change too much. The market is probably getting used to it in a way, not in every way, but in a way, the market knows, investors know that, I mean, there's how much? Thousands of ships are still stranded at sea who can't go into ports, and it's not going to change overnight. So I'm not even sure if tomorrow CPI, if it comes in line, is going to create such a big move on the dollar pairs. It might perhaps weigh a little bit on risk. And mechanically put a bid under the dollar in a way, but I'm not looking at tomorrow's CPI to change the overall picture.
Okay, so you're not going to use.
If I may, just before you go to Stel, one thing we're talking about in the room at the moment, it's not so much what expectations for rates are; it's what the Fed members are seeing their neutral rate as. Where they all settle on a neutral rate, be it 2%, 2.5%, 3%. Is going to be the guideline for what the market is going to price for rates.
Yeah, that's what I said earlier, right?
Yeah.
Are you all done?
Yes.
Yeah, go ahead.
Take it away.
And let me just point out really quick, just some price action here, Stel. I mean, the dollar is still really struggling at the 2017 highs. We are consolidating exactly technically where you would expect. We are, if you take the trend line from that was, formed from the 2017 highs, post-COVID lockdown highs, to where last week's low was, we hit it to a T, and we're capped by the 2017 highs. So the dollar index seems like, and this is why it's such an important conversation that we're having. It seems like the dollar is waiting for a break higher or lower. And obviously we are in a bullish trend. And so, but we're up against key resistance. And that's why, if we break higher, you got to imagine we just consolidated and we're ready for a whole new leg higher. Euro's heading to parity, blah, 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 blah. But a break below 102.20, or let's just call it 102, and we might get a dollar recovery. So that's why I think I personally believe it's the CPI data this week that is going to break us one direction or the other. That's why I'm trying to get a gauge from you guys. Okay, Stelios, what do you got here?
I agree with that assessment. However, I don't see what's going to make inflation print lower. We are already expecting a little bit lower than last time. I think last print was 8.5. We're expecting 8.1. Yeah, I'm not convinced, but obviously, a print is a print. You can have a variation from one print to the next, but I don't see yet what's going to drive inflation or what's going to bring peak inflation. You're seeing everywhere. Inflation just keeps going. The Norway CPI today, 5.4%. year on year, up from 4.5, and it was expected at 4.7. So there just seems to be no stop in sight. And you know me, I like the technical stuff and the more short-term stuff, but I like to just take a few steps back and look at the big picture. And for me, the big picture has not changed. And however, having said that, if CPI does come in weak, then I think that's going to be pretty significant. We're seeing 10-year US back below 3%. The dollar is consolidating, like you're saying. So we are at a very crucial level. I mean, 3% in 10-year yields is very important. The number tomorrow could push us the other way. It could be, it could be the peak of the dollar. It could be everything, but I'm not convinced yet. If you've put a gun to my head and tell me, what do I think? I think inflation is going to beat expectations. End of story.
That is the path of least resistance, right? I mean, it is. I mean, the path of least resistance right now is the dollar is going to continue to strengthen and inflation is going to continue to stay hot or persistently hot, and the dollar is going to reap the benefits of that. But let's talk really quick. And thanks, Stelios, for your.
Just one more thing to add. Sorry, Blake, one more thing. Our friend Richard
we're done
says,
with you.
Okay, bye.
Nope,
our friend Richard asks, can the strong dollar push down inflation? Yes, but not from one day to the next, or 1 week, or 1 month to the next. This is a slow process. I think this is going to be the last hurrah for the dollar higher, and then it just starts on a long journey south. You can go now.
Okay, thank you. Well, I've been looking at this pattern in gold, and gold, I've been drawing it a couple of different ways. I've been looking at it like this, a Gartley pattern like this, thinking, okay, well, we could, dip down to this might be it. This is from like 2 weeks ago. This might have been it with the 127% extension. But then, based on price action, I'm like, and I've always thought we could go see the 200-day moving average or these trend lines here as they are intersecting basically where we're at. And you know what? I mean, gold, maybe we get that one last plunge, following the CPI data tomorrow. Let's say the data is, kind of hot, and you see a dollar surge, you see the dollar, the euro punch below 105, and gold's going to naturally dip down to the 200-day moving average. Maybe that's going to be an opportunity to get long gold. For those of you that are watching, I have to point out that some of these cryptos, I mean, let's not ignore the obvious here with cryptos. All right. First of all, we broke out of these channels, big channels that everybody's looking at. It hasn't been just me. Everybody's been staring at this big channel. Crypto has broken down, towards the $28,000-$30,000 level. We're finding a bit of a bid this morning.
It measures negative 15.
What's that?
It measures negative.
It measures to a negative 15, which could honestly get there. But we see Ethereum's breaking lower, and everything's below these, key channel supports. However, they are catching a bid today alongside risk. And, I wanted to point out that the S&P, even though it's breaking down, tomorrow is going to be really the key data, right? I mean, tomorrow's the CPI data, but we hit the 127% extension overnight. In Europe, that dip to new lows in the S&P actually tagged it to the pip. The DAX yesterday hit the 618 retracement. Today, we pushed a little bit further below, but you can see that the, relative strength, as we pushed lower, it got really oversold and we bounced back. I mean, we are seeing, you can see European markets everywhere are starting to stabilize. I don't know if that's a start of something, but, after being down so aggressively for the last several days and it being Tuesday, what are the odds, Dale, that we get a turnaround Tuesday today?
Yeah. Could,
I mean, it's
in
possible,
front of the number.
People ahead of the number, right? Number. And what would confirm a reversal would be the data tomorrow. Now, I personally, I can't imagine being bullish the S&P until we get back above 4,100, and that's far away. I mean, 70 S&P points is not like a drop in the bucket. It may seem that way sometimes because volatility has been high, but the S&P is, we still have a lot of work to do. And speaking of volatility, I want to point out that we were looking at the VIX yesterday and realizing the VIX was stalling and not making new highs, which also gave us an idea that the stock market was going to, kind of bottom out yesterday. But I'm not opposed to thinking the stock market has further to go, because technically we still look like we do. But what are you guys thoughts here? We have 5 minutes before Dale brings in his guest.
Can I add
Adem,
something about cryptos?
Yeah.
One thing that scares the crap out of me. Maybe it's because I don't understand them that well. But you remember people talking about Tether and all these stable coins where they're backed 1-to-1 by dollars, and people use that to buy Bitcoin and all that. And everybody was saying, yes, Tether is used to buy Bitcoins, but it is fully backed and it's going to be always 1-to-1. Well, I was reading about this other stable coin, in quotes, which lost 40% of its value, and it was probably one of the main reasons why cryptos and Bitcoin were crashing. So all this stuff just scares the crap out of me. It's it just feels like a great big pyramid. But anyway,
I mean, but you have to imagine, I know we've had this conversation so much, and I'm going to say it again. How many of these coins have gone, basically they're worthless or close to worthless at this point. There are the big names like the Bitcoins, the Ethereums. There is technology that's going to come out of this whole situation, right? And those are going to be the ones that are going to be the standouts. And is Bitcoin going to be 400 times its value in 10 years or 20 years, like people think, whatever forecasts they have? I don't know about that, but I do think that it will provide some sort of technology for transactional technology in the future.
Of course.
And so there's obviously a value there. I'm more in the camp that Bitcoin's going to be one of those things. It's it's 30,000 right now, and maybe in 10 years it's going to be worth 60,000, or something like that. I'm not in a 100 multiple time crypto person like all these hype people are. But it
needs dot-com bust. That's what cryptos need. They need the dot-com bust.
We're already there. Are we there?
No, you got how many coins in circulation? 30,000 different.
I don't know. I don't look at them all. I mean, who follows coins closer than I don't know. I'm the wrong person to ask. Maybe I should just pull up our sponsor of this webinar is 8Cap Securities, and they have like a lot of crypto products. So I'm going to go through their feeds and start looking and seeing what charts they have. But I mean, if you go through cryptos and you look at them all, well, hell, we can do something like this, and I'm just gonna do this. Let's delete and go into crypto and just start scrolling down and looking.
There's 19,388 cryptos at the moment.
We should do analysis on all of them, right?
Yeah, I mean,
you can say that webinar.
we could, but anyway, I don't know. We'll have to go through and look at all the different coins, but I would venture to guess that a lot of them are not worth much anymore. But anyway, I think that the solid ones are finding a bid, and I believe they are going to be like a substitute, alternative, whatever you want to call to like gold and silver. That's what I think they're going to trade like, and I think that that's going to be their role from an investment standpoint. Is you will have people like, my kids, your kids, that are going to say, yeah, I got a little crypto in my portfolio. I own some Bitcoin, and maybe they transact it like, I'm going to give you a silver coin, and you say, all right, Blake, I'll give you $50 for that silver coin. I'll say, okay, you can have my silver coin, right? I think that's what it's going to be like. But anyway, it's neither here nor there. But I want to say, hey, last minute, we have just a couple. Wait, do we have data coming out today? Any data? Sorry, nope. Stelios, where are you?
I'm just here. No, we don't.
Okay, good. Okay, so and here's ForexAnalytix. There's data flash just to see if there's any data, and there isn't. So, so before we turn it back over to Dale, KMan any last minute hoo-yah things that you want to say?
No, not really. I mean, yeah, I think the interesting thing will be the central bank's neutral rate. If it's around 2.5%, rates can stabilize a little bit, in my opinion, and then we'll see. I still keep my view that the real test for equities will be when QT starts, and that's it, basically.
Hey, I'm going to show you guys something really quick. Ryan's here. You guys want to see that? This is something that's coming up for you guys starting next week. All right. It's called the Flow Show. Yeah. And it's going to be a show in European hours for those of you that are in different parts of the world that are, not North America, and you're like, man, I wish there was some coverage a few hours, ago. Well, guess what? Ryan and he'll be joined by a lot of people from the ForexAnalytix team. We'll be, looking at the Flow Show. So it's every day, every trading day, just like the F.A.C.E webinar that you're listening to right now. What time, Ryan?
9:30 GMT, 10:30 UK BST.
Yeah, and that is starting up next week. So you guys and gals, get excited for that. I hope you are.
So Blake, we have Ryan Seacrest in the US, and now we have Ryan Littlestone out of the UK.
Yes, lucky us.
You can never have enough Ryans in this world.
Well, really excited to have Ryan and his own show, but more importantly, coverage for you guys and gals in the European hours. Where there is obviously a lot of volatility, and so you guys can be abreast of what's happening at that time. It is going to be a free show. Hopefully it's sometimes it's a half an hour, sometimes it's going to be 20 minutes, sometimes it's probably going to be 45 minutes based on what's happening in the markets. Yeah. But Ryan's going to be there every trading day with you guys, so it's going to be really cool stuff. And there are crazy people like Paul Franco that loves to get up in the European hours to trade that live in North America. So I mean, that does happen. There's a lot of us out there anyway. But I want to say, Ryan, we're glad to have you. Stelios, any last minute comments, really quick? He might have been gone. All right. Everybody, make sure you check out the Trader Funding Program if you want to try to access larger amounts of capital. That is an option that is available to you. There is an assessment fee to go through that, but we have we had somebody qualify for a live account this morning as I got up. So it's pretty cool. Anyway, that's it. Dale, it's all yours. I'm going to pass it over to you.
Okay, thank you, Blake.
All right,
thanks
everybody.
team.
Cheers, guys.
Looking forward to Ryan building a great show during those hours, and he's.
Thanks, mate.
I learn from you every day, buddy. So
yeah, if I struggle, I'll get you on.
All right, Adem, my trading warrior brother. Welcome back to F.A.C.E.
Hey, how's it going, Dale?
Good, buddy. So tell me if my memory is correct. I know you like to buy, outsize move options that, it would take, it's kind of contrarian. And at the time you were accumulating long dollar option positions before it turned into this.
Yep.
I wasn't expecting this much dollar strength. Am I correct? Is my memory serving me?
Yeah, actually, the last big trade, as always, just let the optionality do its thing. I let the black swans do their thing. In November, I loaded up on EWG puts, long dated EWG puts, which is a Germany ETF. And, my thesis was that there's going to be a growing illiquidity pocket, tightening. It's going to lead to stressors compounding in the system, etc.
And you weren't looking for the invasion.
Exactly. And that's the beauty of optionality. It makes the trader seem much smarter than they are, like me. And thankfully, though, I've learned a long time ago that you don't let it go to your head, because you can't price these things in. Anything can happen. You can be right about a thesis, and still lose money. Like how many
Yeah.
times have you
Wrong
you
about the
opened a
timing.
trade exactly? There's and I've learned
Right
that
the
the hard
market,
way.
wrong the trade.
Yep, and I think that's a big problem that many investors have is that they confuse being quote unquote right about a hypothesis and still
Yeah.
losing money. And then there's like, me, I was wrong about my hypothesis. I didn't expect Russia invading Ukraine and then the ripple effects from it into Germany, and
Right.
it made my puts 500%. So
Nice.
I'll take it. And yeah, so and like you were saying, like the strong dollar.
So you're going to share your screen today?
Oh, sorry, I thought I already
Anything
was.
to show?
Let me do that
And
right now.
are you on one of Elon Musk's spaceships? I thought I heard a wind tunnel or something.
Oh, can you
Better
hear?
not.
Oh, I'm very sorry about that. Might have been my fan. Is that better?
Yeah, better.
Okay, perfect.
All right. So there's Adem. And
Okay, great.
Where do you study up there on the top of a mountain up there? Is that you?
Oh, I got a ton of just random,
Spaces?
bookmark researches and everything. Yeah.
Yeah. Okay.
But yeah, so I just thought, pick up where we last spoke a few months ago. We were talking
Okay.
about, long dollar. When we're seeing, what's interesting today is that I think this is one of my favorite charts. I've written about this before. This is the Federal Reserve Chicago branch, their National Financial Conditions Index, the NFCI. And this is basically a liquidity index. It's an accumulation of multiple liquidity indicators. And why I like this one is that it also accounts for shadow banking. And as your viewers can see, here are the sub-indexes. So that make up the NFCI. You got risk, credit, leverage. Leverage is the leading indicator of these three generally, since in the post-80s economy, leverage is the key to the global financial system. So what I found very interesting is that the higher the number means the tighter, so less liquid markets are, and the lower is the more easing. And generally, since the 1980s, we've seen a global glut of savings, meaning that and I get a lot of pushback from this, people saying like, what do you mean there's a savings glut? People don't have savings. That's not what a global savings glut necessarily means. The normal saving, like for instance, corporations, the wealthy, even the top 1%, which hold most of all the, if not all the wealth in the world, the export heavy surplus countries like, the Middle East, China, Germany, the European Union, etc. They also have to store their money somewhere. They can't put it under a mattress. They can't just open up a bank account and say, here you go, right? Like to them, they have to buy usually bonds. They have to find places to put that money. And generally in a stable or healthy economy, savings is the same, or in economic theory, savings equals investment, because every dollar someone like these export countries put in a bank or buy a bond is fueling a creditor. Like America can run the deficits, or essentially there was a study that came out by the Fed showing how the global savings glut since the 80s has essentially fueled the debt trap for the bottom 90%. So the top 10% savings, as they've gotten wealthier, as Thomas Piketty, I think one of the only really important things he even ever said was that wealth compounds much faster than growth. Like the rich money in the bank system compounds at a much faster rate than global growth does. And when you have that happening, you have wealth inequality essentially take off. And so when you're having now investments, net investments over the last 40 years has declined, as we've seen. Businesses in the third industrial revolution, which began in the post 1970s, also known as like the digital age, net investment has been way down. The second industrial revolution, which was between 1870 and 1970, known as the glorious century, where we saw most of the greatest inventions, they peaked out. And since the 1970s, we've just seen instead of a revolution, it's been more of an evolution. Cell phones, for instance, the first cell phone came out in like late 80s. It was a huge thing, and then now it's the iPhones. Yeah, exactly. Yeah, and now essentially this iPhone, three has been roughly the same, if not faster, smaller, sleeker, etc., more efficient, but it's the same thing it's been for the past 15 years at this point. And that's what we're seeing all over. Like the last greatest housing, like the modern housing setup where you have like a kitchen, installments, like dishwasher, all that was already in the 1930s. The only thing that changed in housing since the 1970s was air conditioning. And so all this new construction that we see, especially after the post-World War II boom, it needed a lot of investment. There was a lot, especially the reconstruction of the world after that horrible war. But now that takes demand, but now, and a bunch of savings. So we had higher interest rates, which makes sense. But now you have a glut of savings. You're having savings essentially exceed investments. So when you're having wealth compounding faster in the bank accounts, and I don't mean individual like the bottom 90%'s wealth. I mean, the ones who actually make it the bulk of the assets in the banking system, their wealth is compounding faster than net investments are growing. So essentially, a global savings glut is synonymous with a dearth of investments, and we're seeing that worldwide. And another good chart I like to show is
I wanted to ask you what your thoughts were on what has happened to bond markets and the massive amount. Everyone talks about the negative wealth effect in Amazon and the FANG stocks, but the losses in the bond market, from sovereigns to high yield to corporate to municipal bonds. Can you tell me why some people don't think, especially the way the treasuries have acted, that we're not in a sovereign debt crisis? Do you think we are?
And when you say sovereign debt crisis, do you mean that we're going to essentially the debt markets are going to explode, or are you just referring to like just debt deflation as continued?
It's becomes more, confidence is waning for various economic factors, the percentage of debt to GDP. We can't service the debt. There aren't, the Fed was a major buyer, foreigners backing out. Everyone's saying, well, still the deepest market, dollars of reserve currency, but the rate of descent. And I've watched interest rate futures for 1,000 years, and I've never seen this kind of velocity before. Okay. Mm-hmm. And I'm wondering, what your thoughts are. I think it's so undercovered. People talking about the great steepening, but I'm just talking about the structure of bonds and no bids, and even when we have big sell-offs and risk, no flight to quality. Maybe that started to happen, but you see no flight to quality, so all you have is selling in the bond market. And the drops were big. What's the impact here?
Yeah, I mean, it's definitely going to hurt individuals, but who are holding these bonds. But at the same time, when they're buying these bonds, they're locking in those rates. And I think with how low rates were, the floor, we were at less than 1%. And I think rates are still, they're back to where they were in almost 2018, surpassing 2018 because of inflation expectations. But compared to where the CPI and everything has gone, I actually think interest rates have been pretty tame compared to, what we saw in the 70s. And that just shows that there's such a glut of money weighing rates down. And we also had a negative GDP print in America in the first quarter. I don't think that'll be the last. We're seeing Japan, you're right. Foreigners are holding off on buying. Japan at this point, until their currency can stabilize, I don't think they're going to be buying. They're going to have to be trying to figure out their own mess. China.
How can the U.S. Just their interest expenses doubled in a year?
Yes, that's true. So new debt that they have to service. Yeah, their rates have doubled. It's the same reason I don't think Japan blew up or the European Union blew up. We're just seeing this global flood, historically periods of great indebtedness are followed by, slowing growth and deflation. And until we see the structural economy change, there's a great saying that says demographics are destiny. And and there's a chart I like right here.
Here, I'm look at what I'm showing you right now.
Okay.
I mean, is there anything? It looks like a crash.
Yeah, I mean, it does. It is pretty brutal, and I've been holding the TLT. Well, actually, I bought my first tranche in 2018, so it's looking pretty juicy. But I don't think there's. I mean, honestly, who knows? I don't think.
That's a fair answer, because I feel the same way too. That there could be a face-ripping rally coming out of here. Maybe
I do think there will be. I think rates will go lower in the long run. A lot of these things are cyclical, and I think that's the problem with central banks right now, is that they're have cyclical tools. They're tightening aggressively, and I don't think their tightening is going to do too much. I think
Lisa.
As we talked, last time, that there was this is more of a supply inflation. And if you think about it globally, like the supply chains, how interconnected, then you have the economy screech to a halt, and prices rose. We saw like 10% increases just across more of, let's say the CPI rose about 10% across the board. And that's a big increase, of course, it's more than we'd have ever seen in 40 years. But for how things had gotten during COVID, I don't think it's as bad if many people actually, sit and think about, like, hey, global economy, how interconnected everything is in a bit of a crisis, and not to mention the genius politicians doing these aggressive stimuluses, like pouring fire on demand, like the Fed doing the mortgage bond buying, $3 trillion in bond buying since that to me is, there was no point in that. And I think now they're having to deal with those corrections, and it's going to be sharp and severe. We're seeing mortgage applications and things already sink. And sorry, before we go down that, there's this one chart I like, and it kind of shows the global issue today is that fertility rates are plunging. And like we saw after World War, here's a 220-year history of the U.S. fertility rates. And as you see, it was very high, and it keeps going lower and lower and lower. And then we have this one period, also known as the baby boom. And it's from 1945 all the way up to 1960, let's say. And it was as you can see, over 220 years, it was the only period of increase. And that makes sense. The World War II was over. Yeah. The great baby boom happened. But now all this great baby boom is they're aging. The average worker age, by 2030, the U.S. average age of the labor force will be where Japan's was in 2000. And that's not a problem that any central bank tools can fix. And I think and China also has a huge demographic wave coming their way. They have, I think, some 500 million Chinese retiring over the next 15 years. And because of their one child policy, they haven't, had enough. Them. Yeah. And like you and I have talked before, how the system, and it actually is making me kind of wonder when we're seeing a lot of the political side. I know we don't like to talk about politics much, but a lot of the reversal of Roe v. Wade talk and anti-abortion, it kind of makes you wonder, is this their attempt to reverse this falling demographics? Because they must know it's a Ponzi scheme, how Social Security works. You have to have the young pay in to keep the old sustaining once they're done adding to the economy. So for every one retiree, you need about, I've read you need about 2.1 workers from some estimates. And we can't have that in this system right now. And yes, America has looser immigration than Japan. Japan obviously has very tight immigration issues. Same with, but the European Union is also having these terrible demographics. Russia's having these terrible demographics. Actually, the U.S. is probably better than most of those countries, but it's still declining.
How come a lot of people explain this real estate boom by there being such a large number of millennial buyers?
I don't know.
Supposed to replace baby boomers, and I've read demographic studies. Things like Dent is pretty big on demographics, and he that was his bearish argument for the last many years, was, houses don't die, people do. And yet we ended up with this, because of what the Fed did, housing shortage.
Yeah,
So
exactly. I actually think Harry Dent, who, more or less got ridiculed by a lot of the investment world. I don't want to be rude to him, but he was generally right on his great deflation call, because we have had very low CPI until recently, but his practical ideas, market calls were wrong, very wrong, because I don't think he accounted for the cyclical tools the Fed had, like you said.
Yeah.
When you have individuals like when COVID happened, there should have been house deflation as people got removed from their homes and had to liquidate. But the Fed came in and the government came in and said, hold up, don't pay your mortgage, don't pay your student loans. Basically, you can live in your place rent-free, all these things. Oh, on top of that, let's do PPP loans, small business, everybody. Let's just, give everybody on top of that, 3 direct stimulus checks. Yeah. And, to me, that's just the government wanting more control, because if you keep people at the T, and then you have more control over them. Because if you ever pull back, then the people they can't leave. And so besides of a control thing, it was the government doing a short-term fix to making long-term worse. So all that easing, easing that people were excited for, that extra $1,400 in their bank account, 2-3 years down the road now, we've already paid for it. I saw the average inflation tax for the average American is $5,300 a year. So you got a $1,400 stimulus 2 times, 3 times, and you've already paid for it all in higher inflation 1 year out, and you're gonna have to be paying for it multiple years with higher rent and etc.
Yeah.
So
do you think they'll reverse it and break it, and we're going to have a financial crisis because of what the Fed is doing? Do you think he has a shot for a soft landing? And lastly, everyone's fearing recession. What do you think, buddy? What does
I think we're heading for a global slowdown. We've seen some of my favorite indicators are the South Korean export growth. We've seen that already have compared to its peak just a year ago. It's already missing estimates on the way down, especially with the China lockdown. China's a huge, I think a lot of global economists really that I see, they really discount the China effect. China has basically fueled global growth. I read an IMF study that since 2008, between 2008 and 2019, China alone accounted for 49% of global GDP, and most of their GDP.
I brought that up many times to people. I said, so how could we have it both ways? I remember during the Great Recession, China was still the only engine of growth, and economists were giving them credit that they could help pull us out of it. So, they could take us into one. Yeah, they could take us into one too, right?
And we've seen that happen. You're right. And ever since, this chart I have up is just the natural rate of interest, which is where interest rates would be effectively without the Fed.
Go back to your demographic chart. I had a question from a viewer.
Okay.
He wanted to know where I was on this curve. We haven't gotten there yet.
Yeah. So 2001 was.
I'm at new lows.
Oh. Yeah, we are at new lows. Yeah.
So he wanted to know where I was personally in the. So I'd be, I don't know, maybe down where the 1 is on the left-hand corner. All right, ride the curve. All right. So.
So like you were saying about China, so another great macro index is the China Credit Impulse Index, and as we've seen since 2008, every time there's been a bust, China has eased. So that will be the blue line. So they've pumped credit into their system.
Right. They're doing it again.
Yeah. And then every time they try to pull back, it leads to 2014 to 16 slowdown. So they have to ease again. And then they tried doing it in So finally in 2018, President Xi came out and he said, we're going to switch from low growth investments, which was basically the property, fueling property markets, high land growth, all, things that didn't actually help the economy. And he's like, we're trying to go back to high quality growth, which to me meant they're going to try to expand their current account surplus. They're going to try to boom exports. And we saw that. And then they were going on that route. They were tightening. Oh, well, what do you know? 2020 happens. They liquefy, and they were the only country in the world that was dumping their exports everywhere. So even in that supply crisis, we've seen their current account hit multi-year highs because they're trying to export their way out of a recession. But now we're seeing their exports fall, and they started tightening again in 2021 after they got what they wanted. They're not bailing out the world like before. It was just a sharp tightening, but now they're starting to liquefy again. They're actually the only country right now easing.
Yeah.
And everywhere else is tightening. That's why I've gone long China. I think after this brutal sell-off, especially with the Russia-Ukraine noise affecting China, I thought it was a good opportunity to go long China, and I still do. It's not because I like China's fundamentals, like we've talked about. Me liking something or thinking it'll work out has nothing to do with a trade. I just think as a expected value perspective and a contrarian perspective, long China makes sense because credit in the post-1980s hyper-financialized global system, it's credit flows that generally drive asset prices. It's not growth anymore. It's not economic growth. We've seen recessions. That doesn't impact markets anymore, roughly. It's how much growth credit is flowing into the system to pump prices higher. And I think as China's the only one liquefying, yes, they have some noise right now with their China, the lockdowns. There will be noise, but that's why I locked in long-term calls on China just to take advantage of their credit.
Is it on the FXI?
Yeah, it is on the FXI.
Okay. All right.
So we'll see where it goes.
Was that supposed to be a secret?
No, it's
someone subscribed.
Yeah, it is for subscribers, but the specific ones I use are, there aren't many,
anyway,
China call.
Sorry,
ETFs.
buddy.
No
anyway,
worries.
All right, it's okay.
But that's just one idea that I like, just because, like you said, like China has been such a major engine of growth, the locomotive effect. They are essentially carrying the world.
I know a wave guy who's real bearish U.S. The only market he's constructive on that he thinks is going to make new highs, I think, is Shanghai.
Yeah, and they've had such a brutal sell-off already, and I think just with their many people discount the lag effects between tightening,
how
like
long
we
it
see
takes.
exactly. Like we've already seen the curve invert, and to me that means the U.S. like
wait till QT starts, huh?
Yeah, and that brings me over to this chart. There's been a lot of tightening that's been allowed to happen because, as we see, banks, this is the overnight reverse repo agreement. It's already back at year-to-date highs. It's at 1.9 trillion roughly. And that means there's 1.9 trillion. They have to drain. This effectively means for viewers, what QE means essentially is the Fed was forcing cash, meaning a zero yielding asset, onto the banks and the financial system while sucking out high yielding assets. Banks want yield. They don't want cash. They lend out cash, right? They don't want to pay interest on more cash. They need to make that cash work for them. So when the Fed, hence that's why they do QE. It's essentially saying, hey, we're going to force you to lend out cash. But you get to a point where you're pushing rope. So they gave the banks, starting in 2020, the COVID, they gave them an insane amount of QE. Essentially, all the QE they've pumped in the market has just been sitting, and banks don't know what to do with it. So they had to send it back to the Fed in the reverse repo. They're like, hey, give us those treasuries back, meaning they were giving them cash and then they were lending them back their treasuries until the QET happens where they can get their treasuries back. Yeah. And so there's $1.9 trillion. This has effectively been a soft tapering, if you think about it, because the banks didn't lend any of that QE. It's just been sloshing around in the cloud of finance, allowing Wall Street and asset prices to boom ever higher, the cheaper margin. And while nobody else says, we actually see loan and leases have been declining steadily the last 40 years. So the, demand for money has eroded in the real economy, but in the cloud of finance, there's never been more, money sloshing around.
Great interview, Ed. Like
usual.
I
really appreciate it, Dale.
Adem, you want to show your website so people could,
oh yeah, sure.
Even though they know about FXI secret?
Yeah,
No?
it was just one of many. I mean, now with all these sell-offs and everything, it's
And
creating good
great call on the
opportunities.
dollar, buddy.
Oh,
So
thanks.
yeah, I think you're a very insightful guy, and
Well,
I'm
I
a
just
fan.
let the black swans do the work for me and
Uh,
get to just read books and
Yeah. Well, when I was in Chicago, I didn't see a lot of black swans, but I sure was dodging the pigeons waiting for the train.
right.
So, so there's where you could follow Adem and check out his website and
Yeah, you guys can check out my Twitter if you ever need anything. And
yeah,
and yeah,
and the radical's good because it's his thinking. He has radical thinking, and how many people put on trades they, may not be bullish on, but it makes sense market wise.
right. That's one of the greater things I learned from Nassim Taleb and his group is that you just can't confuse genius with luck and what's right or wrong with profit or loss because they do not follow each other.
Yeah. Well, you learned it early. Takes people a lifetime.
Huge losses made me rethink everything, and since then it's been a lot better. But it happens. Everyone has to suffer a big blow.
And as far as the markets are concerned, everyone put on a little Jimi Hendrix today and listen to Manic Depression's a Frustrating Mess. So that's what I think we have. We have manic markets, and that's why you take it when you have it too, or you go with the telescopic method like Adem does, and you go out and you buy a lot of time. At Radical Adem, Richard, ADEM. All right, my trading warrior brother, I'll get a hold of you on Twitter, and we'll schedule your next one.
Yeah, it's always a pleasure, sir, and I hope everybody else has a great day and good luck out there.
Yeah, good luck on this China call. I'm gonna maybe put some on.
Well,
so I could blame you. So I could blame you when it doesn't work out.
All right, no worries, sir.
Look, I'm a big boy. All right, Adem Turkman, really great to Merkin, really great to talk to you today.
Great, thank you, sir. Have a good day.
All right, bye-bye. Don't call me sir anymore, okay?
All right, Dale, take it easy.
Dale, there we go. Adios, everyone. I thought you enjoyed it. Hope you enjoyed it. Yep. And the team will be there in 14 minutes, go over the bias charts and many other things. And what, great news about the Flow Show coming up with Ryan, and think that KMan's great. And you ought to get in the chat room and see some of Amanda's calls. I see them come across all the time on TradingView. So we have a good team, and they all care about you. So remember, most of all, don't just count your pips, count your blessings, and find a community of like-minded people to hang out with. Adios, everyone. Thanks again, Adem.